$85 million in collateral. That's what a major agricultural lender believed it had locked down. Cattle they could count in spreadsheets and borrow against. Then someone finally walked the pens and counted by hand. Almost none of them were there. 79,000 cattle gone cattle that had never existed at all. His name was Brian McClain, a Kentucky cattleman out of Benton, church volunteer, family man, the neighbor everyone trusted. For years he ran what looked like one of the largest private cattle operations in America. 80,000 head, he said. Maybe more. An empire built on calves, feed, and profit. But here's the part most people miss. The fraud wasn't really about cattle. The cattle were almost beside the point. The real story is who was supposed to be counting them, who signed off year after year, and why nobody walked the pens until it was far too late. And if you work in lending compliance or fraud detection, here's the question to hold on to. How would your controls catch collateral that simply isn't there? Because the trick McClain used isn't unique to cattle. It works on metal in a warehouse, on apartment buildings, on anything you finance, but rarely physically inspect. This is a blueprint, and it is still in use today. They called him the Bernie Madoff of cows. Over $100 million gone, dozens of ordinary investors wiped out. 3 banks now standing in a courtroom. This is the story of the ghost cattle. The pitch was beautifully simple. We buy calves at auction, feed them up over a few months, then sell them for a profit. Anyone can understand that. No complex derivatives, no offshore funds, just cattle. And McClain promised investors around 30% a year, paid out when their cattle were sold. Now stop right there. 30% a year consistently in commodity cattle feeding. That business runs on thin margins and brutal price swing. A steady 30% isn't a great operator. It's a warning light. But to investors who didn't know cattle economics, it just looked like a man who was very, very good at his job. So let me ask the analysts watching. If a client showed you smooth 30% returns year after year in a volatile physical commodity, what would your system flag first? Drop it in the comments. That single question is where this whole case could have ended early. Here's the mechanism that kept it alive. Most investors never took their money out. McClain encouraged them to roll their profits straight back into the next batch of cattle. On paper, everyone was getting rich. In reality, almost no cash was leaving the system, which meant he never had to actually produce most of the returns he claimed. And that is the definition of a Ponzi scheme. The returns weren't coming from selling cattle. They were coming from the next investor's deposit. Old investors got paid with new money. As long as more money kept flowing in than flowing out, the illusion held. The moment that reversed, the whole thing was finished. Every Ponzi scheme is a race against its own math. To keep new money coming, the numbers had to keep growing. Reported herds climbed higher and higher. The borrowing base swelled. By December of 2022, his paper inventory listed 89,522 head of cattle, backing a borrowing base of over $97 million. It looked like an empire. It was a balloon. But here's where it crosses from a Ponzi scheme into something more dangerous. McClain didn't just lie to investors. He pledged those same imaginary cattle to banks as loan collateral. Tens of thousands of animals that existed only on a spreadsheet, used to secure tens of millions in real credit. The herd lived in the documents, not in the dirt. Here's how the machine actually ran. Every month, McClain handed his lenders a borrowing base certificate. It said, in effect, here is how many cattle I own, and here is what they're worth. The bank lent a percentage of that number. So the entire loan rested on one input he controlled completely, the head count. Inflate the count, inflate the collateral, unlock more cash. The bank's math was perfect. The number feeding it was a lie. Investigators believe cattle pledged once as collateral were sold, moved, or never existed, while still being counted in the borrowing base. The same or non-existent animals securing financing again and again. In the trade we call it double pledging, and it is one of the oldest tricks in asset-backed lending. The technology changes. The con is centuries old. And this is where the financial institutions enter the story. McClain didn't operate in a vacuum. He needed banks. Rabo AgriFinance, a major agricultural lender, extended what court documents describe as more than $70 million in credit, secured on those cattle that were largely a fiction. The lawsuits now allege the banks accepted his inventory reports and borrowing-based certificates with little to no independent verification. They allowed prolonged overdrafts. They kept extending credit even as the financial statements grew less and less believable. The bankruptcy trustee would later call the banks necessary components of the scheme. Without the financing, there was no empire. Here's the detail that should make every credit risk professional wince. The primary lender reportedly went 4 years without a comprehensive physical headcount of the cattle. 4 years funding tens of millions secured on livestock, and nobody walked out and counted the herd. One honest count any year would have ended it. By early 2023, the illusion started to crack. The gaps between reported and actual cattle numbers became impossible to explain away. Creditors began pressing for verification and repayment. And once people started asking to physically see the collateral, the whole structure had nowhere left to hide. You can argue with a spreadsheet. You can't argue with an empty pen. Then came the moment of truth. On April 4, 2023, the lender finally conducted a real collateral inspection. They counted 7,481 head in Texas and 3,094 in Kentucky, a grand total of 10,575 cattle. That was the entire real herd backing nearly $100 million. Remember the paper inventory. 89,000 head just months earlier. The real count was 10,000. Nearly 79,000 cattle worth an estimated $85 million simply did not exist. Sit with that ratio for a second. For roughly every 9 cattle on paper, 8 were never in a pen. The collateral was almost entirely air, and it had been air for years while the loans kept growing. They never had existed, they were ghosts, a herd of nearly 80,000 animals that lived only in invoices, spreadsheets, and the trust of people who never thought to count. On April 18, 2023, just 2 weeks after that inspection, Brian McClain died by suicide at the age of 52. The man at the center of it all was gone, and with him went many of the answers. What he left behind was a wreckage that investigators are still piecing together today. His 3 companies, McClain Farms in Kentucky, plus 7M Cattle Feeders and McClain Feed Yard in Texas, filed for Chapter 7 bankruptcy. The liabilities ran far beyond any real assets. Over 100 investors, trade creditors, and banks were suddenly facing enormous losses. Cattle producers who sold him real animals watched their checks bounce as the scheme came apart, and it's worth pausing on who actually got hurt. These weren't hedge funds. Many were everyday Kentuckians, farmers and local families who invested their savings because they trusted a neighbor. People who shook his hand at church. That's not an accident. That's a specific kind of fraud, and it has a name. It's called Affinity fraud. The fraudster targets people who share his community, his faith, his social circle. Trust in the person quietly replaces due diligence on the investment. When you believe you're backing one of your own, you don't ask for audited financials. You don't demand a third-party valuation. You just write the check. Belonging does the underwriting for you. McClain understood this instinctively. The comfortable brick home, the manicured lawn, the wedding photos in gold frames, the church service. Every detail reinforced an image of a successful, grounded, trustworthy man. And that image did more work than any spreadsheet ever could. People invested in the persona, not the cattle. Then add the fear of missing out. When your neighbors show off their returns, when the man down the road buys a new truck off his cattle profits, the pressure to get in becomes enormous. Nobody wants to be the one who said no and watched everyone else get rich. So the questions that should have been asked never were. The crowd became its own kind of evidence. But the investors weren't the only ones who fell for it. Inside the banks, something subtler was happening. Risk people call it the normalization of deviance. Small exceptions to policy become routine when nothing bad happens right away. One overdraft gets tolerated, then another, then a mismatched feed bill gets explained away. The standard quietly drops. And every time, the justification was the same. Nothing has gone wrong yet. The payments are still coming. He's a known operator. Why rock the boat over a paperwork discrepancy? That phrase, "nothing has gone wrong yet," is the sound a fraud makes right before it detonates. The absence of a disaster is not the same as the absence of risk. Fraudsters also weaponize complexity. Feed yard operations, cattle moving across state lines, market price swings, mortality culling. When an analyst raised a question, McClain could bury it in operational detail. Weather, disease, market timing. To a non-specialist, Every inconsistency had a plausible-sounding excuse. Complexity isn't just a feature of these frauds, it's the camouflage. I want to hear from the investigators and auditors watching this. What's the first red flag you would have chased here? The smooth returns, the overdrafts, or the 4 years without an inspection? Drop your answer below. The best ones genuinely sharpen how all of us think about this work. Now here's why this case matters far beyond one Kentucky farm. The ghost cattle trick is sector agnostic. Swap the cows for any asset a lender finances but rarely inspects, and the exact same fraud works. Take Agrideem, a Texas company that let retail investors buy cattle for as little as $2,000, promising fixed returns of 15 to 32%. According to the CFTC and SEC, Agrideem allegedly bought cattle for only a fraction of investors and used new customer money to pay earlier ones. Unrealistic returns, opaque use of funds, investors who never verified the herd. Sound familiar? Now swap cattle for metal. In a string of major cases, fraudsters used forged and duplicated nickel warehouse receipts to finance metal that either didn't exist or was already pledged elsewhere. They color-scanned genuine receipts to create convincing forgeries while the originals stayed pledged to other banks. Different commodity, different country, identical trick. The asset is just a prop. And it works on buildings too. Some private real estate syndicators have marketed apartment complexes they didn't actually own, rebranding someone else's property in their offering decks. In some cases, due diligence revealed the advertised projects didn't exist at all. Instead of cows or nickel, the ghost asset is an entire building conjured out of marketing materials and investor hope. In every single case, the common thread is identical. A real-world asset, misrepresented through documentation, used to pull in financing or investor money. The asset changes. The fraud doesn't, which means the defense doesn't have to either. So how do you catch the next McClain before the pens turn out to be empty? Financial crime professionals can attack these schemes through 3 lenses: business model reality, asset verification, and cash flow analytics. Run all 3, and the contradictions surface years earlier. Lens 1, business model and economic reality. Does the promised return actually match the sector? Double-digit fixed yields in commodity production or plain real estate are inherently suspect. Check the volatility too. Real markets are jagged. Ponzi returns are suspiciously smooth, even when the underlying market is swinging wildly, and question the growth. Tens of thousands of cattle appearing without the staff or feed bills to match is a red flag in itself. Lens 2, and this is the one that would have ended McClain: asset verification. Independent, unannounced physical inspections, GPS-tagged photos reconciled against the borrowing base. For livestock, RFID tags, satellite imagery, drone surveys. For commodities, verify warehouse receipts directly with the storage provider and confirm there's no second pledge. For real estate, check the title in public records, not the marketing deck. And here's the rule that ties it together. The person who verifies the asset can never be the person who benefits from the loan. McClain controlled the count, so the count was worthless. Independence isn't a nicety, it's the whole control. Lens 3, cash flow and behavioral analytics. Ponzi schemes leave fingerprints, money cycling between related entities with no real economic purpose, payments to old investors funded almost entirely by new inflows. Big round number payments labeled profits or interest that don't match real trading activity, and constant overdrafts kept alive by just-in-time deposits from the next investor. Tune your monitoring to catch operating cash flow that's always negative but somehow never runs dry. If you want to go deeper on this one, I've put together a full breakdown of the McClain case with the source documents and the bank filings over on davinsadiligence.com, and if you'd rather listen on your commute, the full investigation is on our Spotify podcast, Da Vinci Diligence. Links are in the description. Here's the structural lesson for institutions. McClain's behavior sat in a blind spot between teams. The credit team saw borrowing base wobbles. The fraud team might have seen the overdraft patterns, but nobody combined them. Integrate your credit and AML data into one view, and a client whose funding model looks like a Ponzi rather than a trading business jumps right out. The signals were never hidden. They were just scattered across departments that didn't talk. And one more, because this is where good institutions fail. Don't fast-track the local hero. The high-profile community businessman, the Affinity-based scheme, the man everyone vouches for. That reputation should trigger more scrutiny, not less, especially when large volumes of other people's money are involved. The brighter the halo, the harder you check. Charisma is not a control. Finally, watch the soft signals, the things no system flags, reluctance to allow a third-party audit or a site visit, aggressive pushback when you ask for underlying data, pressure to decide fast, framed as a last chance, and an obsession with reputation and testimonials instead of transparent numbers. Train your front office people to spot these and escalate them. The biggest red flags are often behavioral, not numerical. So where does the case stand now? This is no longer just a story about a dead fraudster. It's become a fight over who else should pay. The court-appointed bankruptcy trustee has gone after the banks directly, calling them necessary components of McClain's Ponzi and check-kiting schemes. The trustee alleges the banks allowed the companies to improperly float hundreds of millions of dollars in checks and, in his words, blithely ignore numerous red flags. Investors filed their own class action against Community Financial Services Bank, Rabo AgriFinance, and Mechanics Bank, claiming the institutions enabled the fraud by ignoring the warning sign. The banks firmly deny it. Community Financial Services Bank called the claims entirely without merit and filed a motion to dismiss, saying it acted in accordance with all applicable laws and regulations. Rabo AgriFinance said the courts will ultimately have the final say, and that it remains committed to serving cattle producers and feedlots. Every party here is entitled to its defense, and these remain allegations to be tested in court. And here's the twist that keeps this open. In late March, a federal bankruptcy judge actually dismissed the fraud claims against several of the banks. But the trustee fired back almost immediately, filing a motion to reconsider. As of now, the legal saga is far from over. More than 2 years in, with banks, a trustee, and dozens of investors involved, it may just be getting started. Why does the bank question matter so much? Because if lenders can be held liable for ignoring red flags on collateral they never bothered to inspect, it changes the incentives for the entire industry. Suddenly, that 4-year gap between inspections isn't just sloppy risk management, it's potentially actionable. And that possibility alone may do more to fix collateral controls than any regulation. If there's one line to take from this entire case, it's this. The old rule was trust but verify. McClain proves that's no longer enough when large volumes of other people's money and movable collateral are in play. The new standard has to be verify and then decide whether to trust in that order. Verification first, relationship second. That single reversal would have saved $100 million. So burn this pattern into memory. Unrealistic but steady returns. Collateral that's rarely physically inspected. Profits reinvested instead of paid out. And a charismatic operator everyone vouches for. And if you run the controls, 3 fixes would have broken this scheme. 1 independent physical count a year. Credit and AML data sitting in one view, and permission to escalate the local hero everyone trusts. None of that is expensive. All of it was missing. When you see those 4 together, you're not looking at a great business. You're looking at the early shape of the next ghost cattle case, the next empty pen that nobody has counted yet. But don't lose the human part in the typologies. Behind the $100 million were real families who trusted the wrong neighbor. The whole point of getting this right, of walking the pens and counting the herd, is so the next group of everyday people doesn't lose everything to cattle that were never there. If this investigation changed how you'll look at a borrowing base or a collateral report, subscribe. I break down a new financial crime case every week, the kind they teach after the fact instead of before. Share this with someone in compliance, lending, or fraud who needs to see it. And next week, I'm tracing how forged warehouse receipts let a single shipment of metal get financed by 4 different banks at once. A $250 million fraud built on color photocopies. Subscribe so you don't miss it.